I'm going to ask a few questions to get it started. We don't have as much time as we'd hoped because of the long-winded Economist. But so we're going to run through and actually try to learn something now. And I'm just going to start with some basic questions. Is the telecom sector right now, both of you, is the telecom sector viewed as a good place to put money for investors in the current environment or in the near-term environment?
I mean, it's clearly been a challenging sector for earning its cost of capital over the last decade, 2 decades, 3 decades. It's clearly been a challenging sector to invest in terms of actually earning its cost of capital. I mean, there are certainly business models in there which have worked. The tower companies, obviously, because of the nature of their cash flows, has actually been something that investors have been very interested in. T and BZ, because of their dividend stability, people have found good investments over time, but neither of them tend to barely earn their cost of capital. If you look at Sprint, Sprint doesn't earn its cost of capital, and then if you get to analyze other businesses, I mean, they're always in a state of going out. They get capital, they get debt and equity, and they end up either sort of in bankruptcy or restructuring. And so I think there's a lot of good ideas out there and places to invest. Unfortunately, we've had a lot of trouble earning returns over time in the sector. Part of it has to do with public policy. Part of it has to do with just the actual amount of capital that has to be put to work to actually make these things work. And if you don't have business model certainty, so you're constantly creating regulatory hurdles that people have to overcome, or worrying, sort of mismatching horizons on we're focused on consumer prices, but not understanding that people have to earn economic rents. It creates a lot of chaos, and I think it's made it a difficult sector to invest in from that perspective.
Yeah, if you look at from a sector perspective, if you look at it on a total return basis, so the way I look at it is cash on total cash and equity invested in the assets that serve customers. Basically, if you use total CapEx as a proxy for what you need to keep putting into the business, the average return today is about 6%. If you say no, these companies invest 15% of CapEx as percent of sales, but really, if they were just standing still, not growing, it might be a fraction of that 15%. You could goose the return into a 7 to 8% range, but that's one of the challenges is that, as Chris was describing, that the return on gross invested capital is not very strong on an industry perspective. I think the biggest issue and challenge for the industry, if we look at it in total, is revenue growth or the lack thereof. And I think one of the key things is if you look at telecom revenue growth, our estimation over the last 9 years is an average industry revenue growth rate per year of about 1.8%. And over that period of time, nominal GDP is growing around 4%. And so there is one of the biggest challenges, what I like to describe as our teleconomy has, is that you just don't have a substantial amount of revenue growth. And partly it's because you have to look at the category as a whole where you have product substitution. So you have, basically broadband substituting for voice, whether we call it voice over IP or the way in which people use and pay for services. And so I think that's the biggest challenge to the industry right now is the absence of strong revenue growth. Even with, if you think about how much we use our products today, the utility that we get out of it. If you measure utility on a scale, I'd say the utility for customers is growing a lot more than 2% per year in terms of all the amazing things that you could do with your products and devices and how you spend your money on telecom. But yet, the carriers have seen a modest amount of that in terms of revenue, and then there's pressures on the costs as well as you're investing in these new sets of services. So I think that's the challenge to the backdrop of investing, and why valuations have performed the way they have.
Two other ways to look at that is I saw an analysis done of looking at AT&T and Verizon EBITDA less CapEx, what that amount of value was being created. And then you look at the rest of the industry. If you did that same analysis, the rest of the industry didn't earn any profit at all. Right? And so it's sort of all accrued to two companies. And I'd also add, if you look at sort of marginal revenue dollars relative to marginal cost, both voiced in like texting in terms of the wireless world were very high margin products. I mean, you go build a network and you could add as much customers to that network as possible, and it's sort of dropping to the bottom line, and you have your CapEx to continue to build it, but that was a good equation for a long period of time. With data, the problem you have is you're substituting a $30 texting plan for a $30 data plan, and the cost to actually provision that data plan is a lot more expensive, either in terms of the spectrum or in terms of the towers you need to build, or these DAS networks and stuff you have to add to them. And I think it's only getting more challenging now. And I think we'll probably face over the next 10 years a massive realignment in terms of business models as people try to address this. And so AT&T is obviously trying to deal with this through T-Mobile. It's more their way of going after it. Verizon is going to have the same problem to work on, and then the rest of the industry has to try to scramble and figure out how do they merge, do they shed businesses, are there new businesses they can get into to be competitive. So I think the problem's only going to get worse.
So if I just summarize one other thought on this is just that, so there's four things to think about as to why I think it's a challenging backdrop for investment over the long run. So sub-GDP growth in revenue, a lot of competition chasing that revenue, an elevated level of capital intensity that incorporates the spectral intensity of the business and the regulatory environment. And for those reasons, it contributes to the way we describe investments to our clients, which is in telecom, we look for restructuring opportunities, revenue momentum that tends to be somewhat limited in scope or time, and we look for M&A as a source of option value, but not the reason to recommend a particular security. So that's sort of our approach to how we look at investing for our clients, or recommending investments to our clients, I should say.
Well, it sounds to me that like you have Washington in a situation viewing the industry in one way, and what I'm hearing from you is that the large companies are the only ones that are able to eke out any sort of return in this. The returns even there are not terribly impressive. The future business plan is one of questionable sources for growth and significantly higher investment requirements in order to maintain the service expectations of customers, with really not the revenue going along with that. I mean, what is your view of the future structure of telecom and the efficient structure of telecom, at least from a Wall Street perspective?
Well, I'll sort of take a quick hit at it, and then I think, so you can only do so much. You can try to create new revenue opportunities for the industry. So, the extent to which there are new content services that can be wrapped around wireless that, the telecom carriers can take a piece of. That's a revenue opportunity. There's going to be a lot of competition there from the likes of Apple and the Amazons of the world that could come in and find a way to buy capacity and could package it with a higher margin structure, at least at Apple and have other businesses subsidize that and create actually even greater revenue headwinds in the future. So the revenue side of the equation is pretty squishy. I'd say on the cost structure side of the equation, there's a lot that can be done, but it's going to force the industry to think about new things. And I think the AT&T T-Mobile merger was the kickoff of that decade of whatever's going to have to happen, that people are all going to evaluate their place in industry, and they're going to all look at their cost structure. They're all going to realize that this marginal revenue dollar is not as much as the marginal cost dollar, and if we continue to ramp this out through increasing data demands, it's only going to get worse. So I can't continue to sort of exist as I do, so I have to find new ways to structure it. If the industry doesn't go through that change, then I think it's in for a pretty negative outlook. If it does, I don't know that it's a question of how many competitors. I think we're sort of missing it. Like taking a competitor out is actually probably a positive thing. Adding another competitor like a Light Squared, the way it was structured, I think is actually lower prices, lower innovation. What you want is lower prices because we have a lower cost structure, more innovation. And I think that's the challenge everyone has to figure out. And I think people are just starting that.
Yeah, and by the way, just For a quick reference, for all of you who are interested in our disclosures, they're available at the registration desk. Please don't get up all at once. But they're out there if you'd like to review them, particularly the press. Getting into this question of structure, I mean, I think you have this classic situation where there's two ways that I think you could see returns improve, as Chris was describing. You can grow revenue and grow scale that way, or you need to significantly improve the cost structure. And consolidation is a path to improving that cost structure. I think the view from investors is that we are in a very competitive industry, whether it's on the enterprise side of the telecom sector or the wireless sector. And so I do believe that there are opportunities to improve returns and really improve the sustainability of the industry through consolidation. And but obviously every situation has to be evaluated on its own specifics. But I think in general, the other way to improve returns, and I don't think it's going to come from the revenue side, is going to need to come from a better industry structure for these companies underneath.
What I hear you saying, both of you, Chris in particular, is that the industry is in a spot right now where something's got to change, something's got to give. A lot of that change and a lot of that give is constrained by what happens in Washington, D.C. What is your perception of the role regulation is playing in the change in the industry, that it will play in the change of the industry, and what would be your views of what it should play in the changes in the industry?
I think good public policy is very important. And so getting the right regulatory structure is incredibly important. I think we're still living in an old world of regulatory where we're trying to, and I don't spend a ton of time on universal service fund and stuff, but where we're trying to sort of tape together things to find more revenues. If we look at spectrum, I think everyone probably agree that people need more spectrum. We want it in the right places. We want to think about ways to get it to the companies that need it and not just the guys that have the deep pockets. The regulatory interaction with that, while it may have noble sort of goals, is not, I don't think it is dysfunctional and broken. If we look at spectrum auctions alone, every single time you see a spectrum auction, it's associated with the Balanced Budget Act or filling some debt hole. And who in this room thinks that filling a debt hole at the government with a policy objective on spectrum is a good idea, right? This should run itself. We should figure out what the rights, how we want to address those goals and how do we do it with a lighter hand from a regulatory perspective, because I think a lot of the problems the regulatory stuff regimes create is where you set a set of rules around a piece of spectrum or something else, and then you don't envision where the world's going in 10 years, right? And then you have to address that, but you create business model disruption for other companies because you change the set of rules around a piece of spectrum, which might make sense, but then it hurts somebody else's business model, and a lot of that I think could be addressed at the beginning by more thoughtful legislation around how you're going to deal with the regulatory framework to address this. And it overlaps into any other piece of the market, I would think.
Yeah, I mean, bluntly, the regulatory environment plays a very important role in the investing process. And what I've shared in groups like these in the past is simply that my job uniquely is to figure out where the regulation's going and help my clients understand what that means for the business models and the underlying valuations for the companies that they care about. And so we can go through specific issues and specific implications of the evolving regulation, but the most important thing is visibility and predictability in terms of how investors need to make decisions. Investors can make decisions actually fairly quickly in today's market and given today's liquidity in most cases. But you look at what these companies have to do, and these companies have to make decisions, and they're investing in plant that will last 5, 10, 20, sometimes 40 years, and even longer. And the paybacks are sometimes 10 years plus. And so, I think for the companies, it's an extraordinarily important driver. And then for the investors trying to figure that out, the absence of that predictability and visibility simply creates volatility and uncertainty, and that usually hurts the investment process.
Lowers valuation, increases cost of capital, essentially.
Well, I've asked a bunch of questions. Anybody? I have more, but does anybody from the audience want to pick the minds of these guys? This is an interesting perspective that I don't get to hear every day. No? I'm here. Okay, Michael.
I'm not an economist and physicist, but I just have a very simple kind of brain-dead question. We do hear all these rumors every so often about Google going out there and building its own networks, and they're doing these pilot projects. Are they determining this as a bad business too? Because we never hear the pilot projects turning into something bigger.
It's a good question. I don't know the specifics of where they are. I mean, I've seen the same announcements. We've done tons of analysis on fiber, and fiber to the home projects. And it's a tough model. It's a tough model to overlay fiber, and to try to earn a return in a 10-year period, let alone a 20-year period that's meaningfully above the cost of capital, especially as, a new entrant. When you have existing players who are protecting existing revenue or cash flow streams, already have customer relationships, they have an advantage there. I'm a big believer that there's two important issues to watch in this category. A lot of people just simply focus on network and network scale as one category that leads to success or failure, and I kind of lump that into technology. I'm a big believer that the marketing, as long as you can be competitive with your technology, is often a very important driver of success or failure. And so that's where, whenever we look at these business models, we not just evaluate what the network scale can be, but what the viability of marketing scale can be. And I think in the context of new entrants trying to do fiber, they got to have some kind of hook or edge to be able to get share. And sometimes it's not the cost of the technology, but the cost of the subscriber acquisition that really challenges business models in telecom.
So, I've spent a lot of time around Google, and I don't have any more edge on it, I think, than the rest of the world in terms of exactly where they think they're going to go. But as I look at it, I look at what I see as two potential business models there. You have the Android, you have the Google margin structure and cash flow, which I think could be a loss leader for a lot of stuff if they think there's value for them to be created down the road. And it's a company that's actually very willing to go do that. And if you go look at the telecom industry specifically, there's a lot of pieces that they've been cobbling together over the last 5 to 10 years, and people are just starting to, I think, get it. Where you've got all these disparate little things that are slowly being weaved together. But if you look at it sort of on the surface, what's going on is you have the Android platform, which is, I'd say, the conventional model. Well, I think they thought they could come in and be disruptive, like Steve Jobs thought he could come in and have an iPhone with no SIM card in there, and you could sort of just flip from network to network. Google quickly realized that the only way they were going to get scale with their Android platform was to play in the old sort of telecom world or regime, and that's basically how I see Android is put it out there for free, and they're trying to monetize it through advertising and get a credit card hook in there and other things to start to build a big ecosystem around that. And you've got telecom players trying to sort of fight who controls that wallet. But that's sort of like the current ecosystem. Chrome, I would say, to your question, is potentially the next ecosystem. What people are missing is that's the really disruptive business model. And there, what you're trying to do basically is speed up the network as fast as you can, because you need ubiquitous connectivity and storage. And if you can get to that point, so that's a combination of having fiber and Wi-Fi networks and spectrum access for capacity, packaged with low-cost devices, and almost everything Google does for consumers is free, right? And then maybe some sort of marginal charge to some of that type of activity. They probably partner with colleges and the like. That could be very disruptive to the industry. It could be very pro-consumer, but it could be very disruptive to guys that are laying networks down and have a larger regulatory regime around them. And I think that's sort of what we have to watch, and people should think about. From just because it looks like they're not doing anything on the surface, you think there's any projects, it doesn't mean they're not. I mean, there's a lot going on. You could take a look in France, where they're basically running, I think they even call it the Google Access Network. They're basically running a cable TV platform that they're sort of testing there. And I think you could see that come to the U.S. as well over time.
That brings up another point with the focus, intense consumer focus on electronics. You got an iPad up there. Are we looking at mobile networks, Wi-Fi networks, wireline networks that essentially become some underlying commodity that no one really even, consumers don't even see anymore. You get a device and it's just connected. And if the networks do become commoditized, what do you think the implications, financial implications of that are for the carriers?
I think the networks are at risk of becoming commoditized, but what has held us back from getting into this model where you just go to the store, buy whatever device you want, and connect it to whatever network that you like is the subsidy model and the acquisition model of getting customers. So, you know, an iPhone costs the consumer a couple $100, but it costs the carrier potentially over $600, right? So you're eating a $400 subsidy, plus you're paying potentially a commission for that customer depending on the channel. You're paying for the advertising. You're paying to have your stores out there to get and retain customers. So you've got this massive subscriber acquisition model in the wireless industry, which is one of the biggest hurdles to get over because, you know, if you start making a device and you want to make a margin on that device, your price point's here. But if you could distribute it through the carriers who get contracts and get service plans and monthly recurring revenue from that, you know, the carriers can afford to bring that price down much lower to the end user. So the end user is able to get something at a much more affordable level. They pay for their service over a period of time. Certain carriers at times have selectively tried to disrupt that model and say, here's your base plan, and you can either buy the device from me or lease the device from me, and it adds a cost on top of that. But because of just the inertia of the existing model and the number of people that go out from their existing provider and get retained by the carriers by getting a new device, you know, replacement, it's a very hard model to see changing anytime in the near future. So somehow we've got it, the device costs have to come down so low where that just doesn't matter anymore, or something has to give, and that's the big challenge. And so if that were to happen, somehow we're able to get over that hurdle, it would, I think, you know, on the one hand, it risks more commoditization of the networks. On the other hand, it could be a source of marketing and acquisition cost savings for the carriers. So there's a double-edged sword to think about.
I agree. There's two sides to that. I mean, the companies that are most likely to create this disruption is going to be Amazon and Google. Right? So Amazon, you can already see it with the Kindle Fire, and you throw a couple, you know, gigs of data in there a month, and you basically spend the rest of your time on Wi-Fi networks. And you do that through a Prime membership that's associated with other activity you're doing and can be subsidized elsewhere. That's very, you know, much lower customer acquisition costs than somebody else trying to start up in this industry would have. And it could be very disruptive. It could also be a source of revenue opportunity for the industry because you could get, you know, big contracts signed. And so it's a question of can the industry get the cost structure aligned to deal with that. I think Google's the same, you know, the same sort of opportunity because you can get these Android devices if they're starting to come from Huawei with the next 2 generations forward of like TDD, FDD chips in them, and they'll be under $100 for those devices. Now, it's not for the whole market. There's going to be a high end of the market, but that's a segment of the market that could be eroded. And if the industry structures itself well to play with that, then there's an opportunity. If they aren't prepared for that, it could be very dangerous.
What about the difference between acquiring the capital needed for a Google or an Amazon or a content level provider versus the network? I mean, what is it just infinitely easier for the content guys now to acquire investments versus the network guys?
Cost of capital issue, right?
Yeah,
To some extent. I mean,
yeah, I mean, you know, your cost of capital, you know, is going to be based on the risk of your model, and it's based on a number of factors. But basically, you know, your relative success or failure is going to determine that. I mean, I could think of content guys that, you know, probably are in a better position than other content guys, just like for carriers, you know. So I guess the way I would just simply look at that is, you know, over time, this industry is going to continue to evolve. And so we always have to be thinking about alternative ways that this industry could be structured from where we are today, because it's not set that this is the way it's going to look 5 or 10 years from now.
Any other questions from the audience? We got one here in the back. Mr. Brent.
Speak a little bit about companies like Windstream and Frontier that are still very high dividend payers. They're attractive to investors today for that reason. They don't face the issues or the possibilities that AT&T and Verizon do.
I'm sorry, what don't they face the possibilities of?
Well, the opportunities, they're not, you know, they don't have the scale of the two major companies.
Well, if I take a step back, so without speaking to any of those companies individually, but just thinking, you know, more generally about the wireline local exchange carriers, you know, what we've seen is a couple things. So number one, they've tried to improve their operating performance with some scale. So we've seen significant consolidation within the local exchange community. The second thing that's evolved for some of the players is to go out and to diversify with acquisitions in the enterprise category. And so, you know, there was CenturyLink and Windstream that have, you know, recently done acquisitions on that front. And so, you know, the way that these companies are trying to manage themselves is to minimize their exposure to consumer and regulatory revenues, given, you know, just some of the changes that are potentially underway, you know, between intercarrier comp and USF. And so for local exchange carriers, I think we have to look at their scale within the markets that they operate in. We have to look at their ability to provide competitive broadband services. You know, we have to look at their, you know, potential to increase exposure to enterprise. And those are the things that are going to drive their returns going forward. I think the consumer business for the local exchange carriers will continue to be under secular pressure. And so for each company individually, you just have to then look at underneath what they're able to do. And I think some of them are actually doing a nice job of trying to, you know, work their way through it. And so, you know, if you'd like to address, you know, any specific companies later, I'd be happy to do that. But in a general sense, you know, for the category, I think that's sort of what's happening underneath the hood. It's a different model, and it's a different way of looking at those companies than for the larger telcos or the diversified guys. There's, you know, but I do think that some of these guys are actively trying to manage their way through some of these secular and regulatory pressures.
I mean, I largely agree with what you said there. I mean, I think as an investor, I'm always nervous when I see a company that finds another business that they like a lot better than their own business. Generically, that's a warning sign. It doesn't mean that some of these companies aren't going to do a great job of actually navigating through that, and it's the right thing to do. And other companies will take the approach of you know, cut my cost structure and do the best job I can within the industry I'm in. And both could work, both could fail. A lot of it has to do with management and the prices they pay for, you know, if these guys tend to trade at lower multiples, they have good cash flow for now. And any business they're tending to get in are more expensive, right? And if they can leverage a piece of infrastructure that they buy in one market into other markets, that's great. If they have to replicate it every single time they want to, you know, transition a market, I think it's going to be problematic because you're trading a low multiple for a high multiple. You're not going to get good returns, and you may stave off bad events. But I think that's a challenging investment climate. So that, like, I don't know how long-term sustainable those yields are.
As you look at the smaller carriers of wireline, pretty much only guys these days, and even the cable industry that doesn't have wireless mobile play, what are investors looking at as the future of those businesses? Are they going to require that, an acquisition of a wireless play, or buying it or acquiring it or creating it?
I think the cable industry is a satellite I throw in there as well. Sort of pretty interesting things going on under the surface. We've been in an environment, if you think from a macro perspective, where there's been a lot of fear and uncertainty, and investors in this environment have rewarded places they can find certainty, right? And so you've had in that, you know, within that regime, you've had, you know, companies like DirecTV, which had no leverage, sort of going into that regime, was in the process of sort of creating more appropriate leverage in their balance sheet, buying back a bunch of stock. Investors rewarded that. Time Warner Cable, which was spun out of Time Warner, came out with a big dividend and initiated a buyback on the back of that and began the process of levering up. Investors rewarded that as well. I think they're starting to realize now that while return of capital to shareholders is important, it's not the be-all, end-all thing, because all of a sudden when you see things like Cablevision in Q1 or Q2 this year where EBITDA growth stalled, right? And you're starting to see that follow behind with time where cable, there's only so many quarters of that you can have before investors start to worry about the sustainability of those cash flows. So the RLX, which we were just talking about, are farther out on that curve, right? And people are more focused on those businesses and are really worried about the future of those consumer businesses. I think they're just starting to feel like that way around the cable business. I think the companies that are investing for the future in infrastructure and in ways to sort of transition to new business models. So Comcast is doing it through, they have a head end in Denver and they're doing a lot of sort of innovative stuff there, but it's required more investment relative to some of their competitors. I think Dish has taken a different approach than DTV, which has got a better brand and better margins and revenue, to try to anticipate where the market's going to go. And instead of investing in satellites, they're invested in spectrum, and they're looking at potential future opportunities for new business models, right? And that's their ways of dealing with it. And I think all of these issues are just starting to bubble up in investors' minds, and I don't think people have sorted out what's going to happen, but they're realizing there's risk because you've got all these other companies like a Google or something that could come in, and as soon as one of those things gets announced, or as soon as Comcast came in and went competitive with Time Warner Cable in a market, I think that will very quickly, over a period of weeks or a month or two, focus investors on these issues. And I think these are the things that those industries face relative to the telecom industry, is cost structure.
I guess I think we're almost ready. I'll ask one question to end, and just a quick answer. What would you view the prospects of an entirely new entrant coming into the mobile business, say, and acquiring the capital it would need to build a business? Is that good, bad, or forget about it?
Difficult.
It's a challenging environment right now.
Yeah. Okay. All right. No other short questions from anybody? That was great, guys. I appreciate it. Very informative.